Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Kevin Carter, founder and CIO of EMQQ Global out in San Francisco, California. This is an emerging markets and frontier markets focused firm. And these are two topics we have not heard very much about lately. And the reason is that they have not done very well lately. In fact, the last 10 years, emerging markets have had an awful time of it. And which now leads us to the question of why we would dare to bring such a subject up on this podcast. But I'd say that just answered the question, because if something is out of favor, that's when we start to become interested in it. So Kevin, talk to me about your emerging markets. Why now?
Sure. Well, let me first start by saying that, there's two things that are really important in emerging markets. The second thing, I'll leave out the first thing, but the second thing is that when it comes to investing, the emerging markets indexes are terrible. I mean, the index is broken, and it has a lot of flaws. And I don't have a solution for them, by the way. But if you look at the MSCI Emerging Markets Index, which is what most people use, there's other indexes, but they're all essentially the same. The biggest problem they have is that they have a large weight in so-called state-owned enterprises. These are government-owned banks and oil companies. And they're, in addition to being inefficient and having conflicts of interest, there's, corruption is rampant, and people are stealing your money left and right if you're an investor in, a company like the Brazilian state-owned oil giant Petrobras, which is actually included twice in the big MSCI index. It's the second and third largest Latin American holding in the index. And it's the poster child for what's wrong with these state-owned enterprises. And when I got, involved with emerging markets 18 years ago, that when we had some investors that asked us that they told us they wanted to invest in China. The first thing I did was I asked our portfolio managers for a list of the companies in the China ETF, because I figured for these people that wanted to invest in China, the easiest thing to do would be to buy the China ETF. But since, I'm an Omaha type of investor, first and foremost, a Berkshire Hathaway kind of thinker, try to be. I don't care what the name of an ETF is. I want to see what other businesses we're going to own. So I asked for a list of all the companies in the China ETF, in the China index. And what I found was that 80% of the companies were state-owned enterprises, Chinese government-owned banks and oil companies. And these are businesses that, as mentioned, they have all sorts of conflicts of interest. But the bottom line is that they're not trying to grow their earnings in a traditional sense, right? And the banks will make banks will make loans to companies that are already bankrupt so that they can keep their employees, off of the streets. And when I realized this, I got sort of nauseous because, in Omaha, investing is really simple. The reason any business has value is because it makes profits for the owners. And the only way to really grow the value is to grow the profits. And if you're going to buy an index worth 30% of the companies don't care about that, why would you invest in them at all? Now, China was 80% state-owned enterprise. The broad, MSCI Emerging Markets Index is about 30%. And so if you look at it and say, okay, well, how does that play out in investment returns? Well, if you bought the China ETF, if you went back 15 years and said, all right, we want to invest in China, let's buy the China ETF, because there was one China ETF back then, it still trades, FXI. And you bought it because you thought China was going to have all this growth. China's economy grew 400%. The 15-year return of the ETF is negative 50.
Wow.
Right? And why is that? Well, because they haven't grown their earnings. Now, in the MSCI Emerging Markets Index, which includes China and the other 25 emerging markets, it's about a third of the index. And so you say, okay, well, how have they done? Well, the last 10 years, emerging markets have the index has basically gone nowhere. And why is that? They've had negative earnings growth. The earnings have declined by an average of 0.5% a year. So it's hard to see how that's going to change going forward. So I think first and foremost, if you're going to invest in emerging markets, don't use the index, or at least the vanilla index that you get from iShares and Vanguard and people like that.
Very interesting. That's so. If you had picked individual stocks outside of state-owned enterprises, have those performed better over the last 10 years?
Absolutely. The technology companies in particular have, the internet companies have performed the best of all the Chinese companies. Now they're down from their highs of a few years ago, but over the last, if you had invested in the emerging markets internet space, going back 13, 14 years, you're up about 300%. And the index is up, 10 over that 15-year period. So now it's not without volatility. And again, our flagship EMQQ is down from its high 2 years ago. We're down about 50 or even 60% from our very high. So these stocks have been volatile, and even after that 60% decline, you're still up 300+% over that time frame versus nothing for the broad index. So what you have to do in emerging markets is get more targeted, right?
Yeah.
You buy the big broad index, you get all the legacy economy, government-owned banks, government-owned oil companies, and a lot of corruption. And the reason we invest in the internet companies is because this is where the growth is. And what's happening in emerging markets, which is a big deal, it is a huge deal, is essentially three things are happening at the same time. First of all, when you really unwind emerging markets and why do you invest there? Because they have a whole bunch of people. There's 85% of the world's people are in emerging markets. They're young. So it's not just the world, but the demographics are better. So it's essentially 90% of the people under the age of 30 are in emerging and frontier markets. And their economies are growing faster. Their incomes are growing faster. And they're becoming consumers. So it's the 6.5 billion people that are emerging, and they want all the things that we have and that we take for granted. They want more and better food, more and better clothing. They want appliances. They want to go on vacations and go to movies. They want a vehicle to move them around, and they want their kids to go to a great college. And that's the story. And I didn't have to figure that out. That was well documented 20 years ago when I got involved. But the problem is the index is only about 8% historically in the consumer stocks. And at least in the case of the China index, back when 18 years ago, it was 8% in consumer stocks and 80% in state-owned enterprises. Yeah. So why only 51%? Why did you lose half your money? Well, because of that. But what makes this consumer story so exciting in emerging markets is that the emerging market consumer is also joining the second mega trend in the story, which is called the computer. So I had access to a computer when I got to college in 1988. My roommate had an Apple, and all we did was write papers on it. But I had a computer in my presence, and I've basically had a computer of some form ever since in my life. Well, guess what? Most of the world has never had a computer before. They're getting their first computer today, and it's a smartphone. And it is happening at an incredible rate. Millions of people a month in India right now are getting their first ever computer, and it's not on their desk, and it does not have an Apple logo. It's an Android-based smartphone that's getting better and more affordable every year. And if I had talked to you 5 months ago, I would have told you you could get a brand new smartphone in India for $50. And that remains true. But as of July 3rd, you can also buy a brand new pocket-sized supercomputer for $12 in India, the Jio Bharat phone. So those billions of consumers are getting their first computer, and they're also getting something that I've had for a long time, starting in 1995, called the internet, which I first accessed in San Francisco from my apartment in the Marina District on a telephone line with a modem. So I've had the internet for, 30 years almost. Well, guess what? Most of the world never got wired. So as those billions of new consumers are being created, they're getting their first computer, and they're also getting connected to the internet for the first time. And when you add all that up, you get what McKinsey calls the biggest growth story in the history of capitalism, the emerging market consumer. But because these people don't have all of the consumption, infrastructure that we have, mainly and most importantly, nobody has a credit card or a debit card or a bank account, right? And there's no chip readers, everywhere. And so these people are leapfrogging traditional financial services and everything else, and are in many ways more digital than us. But it all starts with getting the money on the phone, digital payments. And that is where emerging markets are very quickly becoming way more advanced than we are. So you take those three mega trends. There's no Target stores, nobody has a car. You take this leapfrogging and you end up with what has been one of, if not the fastest growing sectors ever. I mean, the revenue growth for the EMQQ, the emerging markets internet sector, has averaged about 35% a year for over a decade. That's not easy to do. So This is where the growth is in these internet companies. And, they are very much out of favor. We once, 2.5 years ago, I think we traded at $80+ a share, and now we're at 30. So, I guess there's some sort of contrarian element in at least the graph of the thing. So this is where the growth is. And the other problem that I would mention about the index is none of the internet companies are included in the broad index, which is adding insult to injury. And now I have to confess that they did finally, after 8 or 10 years of me complaining about it, MSCI finally added Alibaba and the other internet companies that were missing from the index. And it was because of Alibaba's IPO that actually the world woke up to this problem. But I'd been talking about it from my very first day involved. When I mentioned, 18 years ago when I got involved with China, I asked for a list of all the companies in the index, right, in the ETF. And I, had been warned about all the state-owned enterprises, and I saw those. And then I got to the bottom of the list and I said, where's Baidu? Because Baidu, which is the Google of China, it was already public and it wasn't in the index. So we called the iShares people and said, hey, we're thinking about putting a bunch of money into your China ETF. We're wondering where Baidu is. And they said, well, we don't own it. And I said, I can see that. Why don't you own it? They said, well, it trades on the NASDAQ, so we don't consider it a Chinese company. And I said, well, it's the Google of China, and some people from the real Google just gave us a lot of money to manage. So it seems like being the Google of anything is good, and being the Google of the biggest country on the planet seems really good. And they said, yeah, well, we don't own it. And I thought this was crazy for a decade. Finally, when Alibaba went public, the newspapers talked about it. It still took 3 years for Vanguard to add Alibaba to its index. But I can tell you that most of the companies we invest in, they're not in your Vanguard or iShares fund. Most notably, perhaps, is the South American e-commerce giant Mercado Libre, which trades on the NASDAQ with the ticker MELI. And this is a juggernaut of a business. It's almost certainly the best performing Latin American stock over the last 15 years. It's not in anybody's index. Why wouldn't you want you had an index to invest in emerging markets? Wouldn't you want to own the Amazon.com of Brazil?
Yeah,
which
sure.
is also the Amazon.com of Mexico and every other country in Latin America. It's also the bank. One of the things about the emerging market internet companies is that a lot of them, when they started, nobody had any digital payments, right? People were paying the delivery drivers or the ride-hailing drivers with cash.
Right.
And as you can imagine, that's pretty cumbersome. And so in Latin America, when Mercado Libre launched and nobody had a credit card or a bank account or a debit card, they created their own payments platform, Mercado Pago, to facilitate this. Well, all of a sudden, they have hundreds of millions of people using their payments platform. Well, then they start selling people insurance, mutual funds, ETFs, making loans. So imagine if everyone in the United States kept their checking account at Amazon and bought their ETFs and stocks at Amazon.
No, I don't. I'd rather not imagine that, if you don't mind.
Well, I don't know, but it was really it was a necessity. There was no other choice. Nobody else was, providing this, financial inclusion, because a lot of these places, the banking systems are old and either state owned or sort of archaic, old school banks with poor customer service and not very user friendly for the new coming up emerging market consumers. So Mercado Libre is not in the index. Nubank, which is the other Brazilian fintech company that's booming, which trades on the New York Stock Exchange with the ticker NU. That stock's down probably 50% from when it IPO'd a couple of years ago. It's not in the index. One of its last backer before the IPO was Berkshire Hathaway. So what is sort of the insult to the injury in this is you get all these government-owned, state-owned banks and oil companies where the biggest problem is corporate governance. These internet companies that are getting funded by people like Berkshire Hathaway, U.S. endowments and foundations, and our venture funds are funding these companies, which is important because corporate governance is your biggest problem in emerging markets. These companies, as is the case with Mercado Libre, the founders are the smartest kids from, South America or Africa or India. They go to the world's best colleges, which are frequently in the U.S., Stanford or Harvard. The founders of Mercado Libre wrote the business plan in the Stanford Library in 1999. And so, but they're not in the index. So you get all these corrupt, oil companies and so forth. But then you find this incredibly entrepreneurial internet and e-commerce and fintech juggernaut, which, by the way, Mercado Libre has been public for, I think, 15 years now. It reported 40% revenue growth last week and 120% earnings growth. I mean, these are well-established companies, but they still have a lot more to go in terms of market penetration. And it's a shame, but this is why this is the second reason you don't want to buy, the broad indexes.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
Okay, 6 billion consumers in emerging and frontier markets. A quarter of those are in China. And almost. And China, as you know, I'm sure, is kind of not having the best time of it right now. And you talk about demographic trends. Well, China's population is slowly aging. And You have a real problem with that. You talk about corporate governance in China. Do they even have it? I mean, it's whatever the CCP tells you to do, right? So, and China, let's not forget, is the biggest importer of commodities, which a lot of these emerging and frontier markets thrive on. So, as far as China's role in this, and does that not kind of is that not a hindrance to the whole investment case of emerging markets here?
Well, it certainly has been recently, and the sentiment is awful right now for China. And let me just say that all of these companies are down significantly. Sure. The Indian companies may actually have gone down more than the Chinese companies, but all of them are down a lot. And China is the biggest part of the EMQQ story. Now, we do have, an ex-China product, which is called FMQQ. And we also have an India-only version, which is called INQQ. But so I'm not here to talk anyone into or out of China. I will say that the vast majority of the things I hear people say about China are just not true. In my, I've devoted, the last 18 years to China and emerging markets more broadly, and have spent considerable time there, and have, in terms of investing in it's public companies and the ETFs. There's probably nobody that spent more time on it than I have. And
that's interesting. So talk to me. What are some of the misconceptions, and how are they wrong?
Well, there's all sorts of misconceptions, I think, but as relates to your question and this discussion, there's been two different things that have made the headlines over the last 30 months, and they were intensely in the headlines, like every week and month. And the first one was the so-called crackdown on Chinese internet companies, starting with Jack Ma is missing.
Sure. Yeah.
Right. And so the problem coming into this, and I realized this a long time ago, from the very beginning of my China focus, the thing I found is that 95% of the people I talk to, they've never been to China. I've been on panels with people talking about China that had never been to China. And they also, 90 or 95% of them, they see all the headlines and they believe them, and they think China's going to steal my money. They're making up the numbers. You can't trust them. The Chinese government just arbitrarily comes in and steals companies. And I've heard all these. I've never seen that happen. I've been involved for 15 years, and I've never seen the Chinese government steal a company. But because nobody, it's foreign to people. They've never been there. They've never touched it, never seen it. All they hear are negative headlines. And so, of course, they come to it with a generally negative view. And anytime that something happens, it gets translated through that lens. So let's talk about the so-called tech crackdown in China, starting with Jack Ma's missing. Over an 18-month period, or 20-month period, maybe, there were 4 different regulatory things that went on in China, all of which, when I say, look at what did they do and why did they do it, I think all of them were actually smart, starting with stopping the Ant Group IPO. Now, the Ant Group IPO, it's Alibaba's fintech business. Again, speaking to the size of this financial services opportunity, if you're the e-commerce leader, many of them have realized their financial services opportunity is bigger than their original business in terms of opportunity. So Alibaba's fintech business was going to be the largest IPO ever, with a $300 billion valuation. And at the last minute, the Chinese banking regulators stepped in and told them to not go ahead with the IPO. And of course, the headlines were, they're mad at Jack Ma. Xi Jinping is personally angry that Jack Ma's getting all this attention. Jack Ma's popular, and Xi Jinping is jealous. And so he's ordered the stoppage of the IPO. And furthermore, Jack Ma's missing. As if Jack Ma was walking his dog and a van showed up and they threw a sheet over him and
I thought that's what happened.
Brought him off to
based on what I was reading,
an undisclosed, torture chamber. And people run with that. Now, I looked at it and I said, okay, well, what's going on here? First of all, if you read the prospectus, the reason it was going to be the biggest IPO ever is it was a gusher. I mean, it talk about a profit machine at scale with a very fast growth rate. Very few businesses on the planet have ever reached that point, and that's why it was going to be the biggest IPO ever. Well, the problem was that more than 53% of the profits came from making loans, which is a business they had gotten into, filling a void for consumer credit and providing it on their website for certain purchases. And all of a sudden, they were originating millions of consumer loans, but they were not being regulated within the financial system. And the regulators didn't like that, right? And so they were already working on changing the laws that would force Alibaba to conform with the traditional bank lending requirements and would have lowered their profitability. And so if they waited until after the IPO and then changed the rules, then investors would have been really mad. So instead, they got ahead of it. Now, that lowered the value of Alibaba, right? As we calculated it, looking through into our full portfolio, we thought, okay, well, that was a decline of 1.5 or 2%, because it's going to lose half its value. But it's going to, and part of the context of this was that they said, well, the reason that the Xi Jinping was mad was because Jack Ma made a comment and at a conference, which he did. He was at a financial conference in Shanghai 2 weeks before the IPO was scheduled. And I think he obviously knew that the regulators were telling them that they had some concerns. And he called the Basel Accords a club for old people. Now, most people don't know what the Basel Accords are. And I had to Google it up and reread for myself. But basically, the world's central bankers have agreed to certain, leverage limits within economies to avoid global financial meltdowns. And Jack Ma's point was that it was written by a bunch of rich countries, or they were put together a long time ago by a bunch of rich people, of old countries. And we're this young country, and we shouldn't have to, follow these things. And so that may have been his opinion. I think it's highly unlikely that Xi Jinping, is personally following that to a point when he would, personally say, we're going to stop this. If you think the second largest economy on the planet is operated that way, then, there's a lot of other things you should maybe worry about as well. But so that happened. Then the next week, the Chinese Commerce Department started an investigation on, monopoly and antitrust issues. Well, that shouldn't have been a secret to anybody, because Alibaba and Tencent were the most anti-competitive companies on the planet. And they threw their weight around for a decade. And that's why, they're not only big in social media and e-commerce, they're also the bank. They're also the entertainment company. They're also the grocery store. They're also the ride-hailing app, which brings me to the third regulatory issue, which was the DDIPO.
Oh, yeah.
So the second one was the antitrust and monopoly reviews. By the way, this is also at a time when the FANG stocks are in Washington, D.C., testifying in front of Congress, and Google, it seems like, writes $1 billion or $2 billion check for some fine in Europe every month. That's not a tech crackdown. That's whatever. But when China does it, oh no, they're trying to kill the internet and kill capitalism. The DDIPO was unfortunate in many ways, because what happened there was that this is the Uber of China. Yeah. And the company was going to go public. And let me just tell you how as an example of Alibaba and Tencent being, monopolistic, we'll give you an example of that. When ride hailing as a business model showed up here in the United States with Lyft and Uber, people all over the world said, that's a great idea. Let's copy it. And so whether that was in Indonesia or Brazil or China, other entrepreneurs took the idea, made a homegrown version. In China, there was about 10 of these different companies. Now, Alibaba and Tencent, had been using this model for a while. They wait to see what new apps pop up, and then they look at the competitors, and Alibaba chooses one and Tencent chooses another. And they invest and buy part of the company and give them preferential access to the tens or hundreds of millions of customers they have. What happens? All of the other competitors die. So Alibaba has made one of them a king, and Tencent has made the other one a king. And so you end up with Didi Dache and Quadai Dache. Those are the two competitors. A duopoly, both with about 50% of the market. Uber announces they're going to go to China and compete and set up a local Chinese subsidiary with $3.5 billion of funding to compete with these two companies. What do Alibaba and Tencent do? They merge their ride-hailing apps to form a monopoly, 100% market share. Uber shows and wastes all their money and gets a small market share and leaves and gives their business to Didi in exchange for some equity. So that's an example of all the monopoly things they were doing. It goes public. It was getting a lot of hype from Jim Cramer apparently that week.
Oh, that's great.
The day after the IPO, they said that a third regulator, the Cybersecurity Agency of China, announced they were investigating the company to see if they were in compliance with all of the national and regional and local regulations in China. And the prospectus said they were not. And the stock was under a lot of pressure and people were wondering what's going on. And it was literally the day after the IPO. And Jim Cramer had a lot of egg on his face. And then they started throwing.
Yeah.
What's that?
Not for the first time or the last, but yeah,
that's
go on.
Right. And then people start throwing around accusations that the company rushed the IPO, that the investment bankers and the company management, they must have known they were going to be investigated. And so they raced, let's get the money real quick before they launch the investigation, which sounds absurd just saying it, but that's a very serious allegation. And so the company had to issue a statement, and the statement read, "We did not know that we were going to be investigated by the Cybersecurity Agency." And then it said, this one line that caught my attention, said, "We received mixed messages from the regulators." And I thought, well, wait a minute, what does that mean? And what that incident revealed was that China was missing part of the system that they needed. You have all these different regulators. You got, the Commerce Department, banking regulators, the Cybersecurity Agency, and a lot of these companies are subject to rules from all of them. But the regulators themselves weren't coordinated, nor did they have clearly defined powers to, stop things from happening. Now, by the end of the week, China put it in place. The way I explained it is, when you go to a different country or come home, there's a very simple process, and it ends when they stamp your passport. They hand it to you, the door's open. China didn't have a central point for that. They have one now, but it left the whole thing looking like what happened. The company delisted. It's actually one of the best performing stocks now.
I was going to say, I just looked at it. It's up 50% over the last year.
Yeah, since it delisted.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details. contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a Contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show.
All right, look, I mean, bottom line here, and you make some very good points about misinformation, and there's no denying that there is a lot of misinformation out of China, and the version that we get here in the US is probably tainted. But at the same time, it's interesting, if you talk to anybody in government, no matter what party, no matter what branch, and no matter what level, they all agree that China is a threat. And there's this whole, new Cold War stuff, blah, 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 blah. Maybe it's not fair. But the bottom line is that Chinese investments have a ton of scrutiny from the US government. And, it's hard to see how there's going to be much investment in China from, your US venture capital and others, which will to drive that country's growth. So what about all of that?
Well, I mean, look, there's no doubt that, we have created a Cold War with China. I find it troubling that, the very fact that their economy might be bigger than ours at some point, where, I've heard well-known politicians state that their goal is to keep China from passing our GDP, which goes against pretty much everything I learned in college about economics and free markets, but it is what it is. And so I don't. And by the way, let me also note that about 25 miles over my shoulder, Xi Jinping and Joe Biden are presumably sitting at a table together, and there's been a lot of movement on both sides, coordinatedly, it seems, to lower the temperature of the discourse, but it is what it is. And again, look, China is always going to be something that is, something that people are going to be afraid of, or a lot of people, may not want to invest in. And that's fine. There's 45 other emerging and frontier markets, and they've got 4 times as many people as China. And what's important to know that in this story, and again, we also have if you want to leave out China, you can use the FMQQ version of the story, or you can just use India, which is, INQQ. But here's another very important part of the story. So China is an emerging market, right? In the traditional sense, it is an emerging market, is going to be an emerging market for a long time. But if you were going to recategorize every country by smartphones and e-commerce and digitization, China is the most advanced country on the planet by a mile. It's not even close. China's e-commerce market is 4 times bigger than every other emerging market combined. It dwarfs the United States. So China is the Jetsons. But you want to think about the way this, I mentioned those 3 trends, right? Consumers, computers, and the internet. Those 3 things came together for the first time, essentially in the year 2000, right? Now, and essentially here in the San Francisco Bay Area more than anywhere else. And now I had the internet in 1995. I had a computer, before that. But in terms of, millions of people having a personal computer at their house or their apartment and being able to connect those computers to the internet, with a wire. And then once they had done that, they could turn on their computer and open a browser, which was a pretty new thing, and go to a website and actually conduct some business, buy a book, sell a book, right? Find an apartment. That basically started in the year 2000. And what happened? 15-year S-curve of growth as the FANG stocks took over our lives and our stock market. First on PCs, then on smartphones. The second wave of this was China, 2005 to 2020. And that's why, the China is the biggest part of the EMQQ story, and its e-commerce market is the biggest in the world. 2005 to 2020, Alibaba, Tencent, Baidu was actually public before Google, as I mentioned. Now there's still growth, but again, that steep S-curve has largely passed. Now you have a third wave coming, which are all the other 45 emerging markets, which have 4 times as many people as China. And while China's e-commerce penetration is 25%, India, Brazil, Nigeria, all of these combined are about 5%. So China, 1.3 billion people, 25% e-commerce penetration. FMQQ, the ex-China, 45 countries, 4 times as many people, 1/5 the penetration. So this third wave is going to be huge, and it's already started. And in many ways, it started in Latin America first with Mercado Libre, but it's spreading and it's everywhere. And I've been out there, and I mean, there's a Silicon Valley in every country on the planet, in Pakistan, in Bangladesh, in Colombia. There are smart kids that went to our colleges and worked for our best tech companies, and they're back and they're building these great businesses. And that's going to go on for a long, long time. And right now, all eyes are on India, because as part of this third wave, there's nothing like India. And India, in many ways, right now, is the perfect emerging market. And that's not a contrarian bet, by the way. People are quite bullish on India, but I think there's reason to be. And I actually think that there's elements to the Indian story that people don't realize that are going to perhaps make it grow even faster than the estimates, particularly when it comes to the smartphone digitization part that we invest in.
Right. So how does one profit from that? What part of how do you what are the companies? And do they trade in the US or do they? Yeah.
No. So here's when we launched 9 years ago, we had 2 Indian holdings. Okay. We had 30 Chinese companies and 2 Indian and some others, but in terms of those 2 countries. And China was about, 60% of the portfolio, and India was less than 1%. And that was still the case 3 years ago. So we had 2 Indian companies trading here. One, Make My Trip, which is like the Expedia or, TripAdvisor. It's a travel app, trades on the NASDAQ, MMYT. And then we had another holding, InfoEdge, which is now traded in India, which is like the Craigslist of China, which was the Craigslist of India. Very, very profitable company. And they created a whole lot of cash flow. And they also invested in some other Indian internet companies that have since gone public. So those are the first 2. They traded here. Starting in 2020, basically corresponding with the launch of the COVID, was the launch of Indian IPOs. So we went from 2 to 25 holdings in year 2020 and 2021. Almost all of them went public in India. So unlike the Chinese internet companies, which trade here and investors could invest in, and Mercado Libre, which trades here, most of the Indian companies are trading in India. And it's very hard for an individual to buy Indian stocks. So if you want to buy the Indian internet companies, the ticker is INQQ, which is our India-only version of the story. And it's incredibly compelling. If you think about like the stereotype, why invest in emerging markets, right? What are you looking for? you're looking for lots of people. Well, India has the biggest population on the planet now. And not all your listeners may know this, but in April, according to the World Bank, India passed China. And as you alluded to earlier, China's demographics aren't great anymore. I mean, 15, 18 years ago, they were good. Well, now they're, everyone's 15, 18 years older. And so India, in contrast, is very young. It's about 12 years younger on average than China. It has more Gen Z than the US and China combined. So it's big, it's young. In terms of that bigness and the size, I mean, you have to remember, you'd have to take the next 6 most popular, the third, fourth, fifth, sixth, seventh, eighth, and ninth countries and combine them to equal India. And that's the scale we're talking here, 1.4 heading to 1.5 billion fast. They're younger. They have the fastest growing economy on the planet. Most of that growth, just as we saw in China, is in the consumer. And in fact, estimates are that the Indian consumption market will pass China's in a decade. You have the fastest growing e-commerce market. It's still at a very low base of, only about half of the people have a smartphone right now, but that's going to even accelerate with the new $12 version. And you have a government that is a democracy, which, some people prefer. And it's not just that, but it has become a very pro-business government in the last decade. And it's also very pro-technology. And so they have supported the technological development. And they also have created something that is amazing, a digital public infrastructure, which sounds abstract, but they have a digital foundation for the country that no other country ever has had developed or emerging. And it's this thing they call the India stack. But this digital story in India, it's already exploding, but it's really good. And India as an investment destination may not be out of favor, but the Indian internet companies are also down about 50% from their highs.
What are some of your favorite companies in India?
Well, I mean, InfoEdge, I like, as an Omaha kind of investor, when I'm looking for moats, I look for the gross margin, right? I mean, to me, that's the front and center where you find the moat. And the businesses like Craigslist, which was kind of a nonprofit here in the US, but in the places on the planet where it was for profit, those were some of the most profitable businesses I've ever seen. And InfoEdge fits the bill.
Is that still trade in the US? Is it still?
No, it's in.
Oh, okay.
It's on the National Stock Exchange of India.
Mm-hmm. Now, wouldn't that be the case to invest in an index fund if you can't access these individual companies? But
as the founder of an India-focused ETF, I hope that's true, and it is true that if you want to invest in China's internet, most of them trade here in the United States. Same with Latin America, and also the case with Southeast Asia. But who's C Limited and Grab and GoTo.
Sure.
They're not in the index either because their headquarters are in Singapore. But it's true with India that you don't really have a choice.
Right. What about other countries? We haven't talked about frontier markets really yet. You touched on Nigeria, but is there anything else? Anywhere else that you're bullish?
Well, I mean, just to stay with the South Asia part of the story, I think most people don't realize that Pakistan and Bangladesh, they were part of India at one point, and have a lot of people and a lot of young people. In fact, they're the fifth and eighth largest countries by population. And Pakistan has a whole lot of, problems with its government and military and so forth. But Bangladesh has a startup called ShopUp. It's private. It's not public yet, but Bangladesh has 170 million people. and it's the size of Iowa. I mean, it's a density that's hard to, it's you can't explain it. But there's an entrepreneur there that he's raised about $200 million from U.S. investors, and he's building the Alibaba of Bangladesh with the sort of iron triangle of e-commerce and logistics and financial services, and I think that company will scale up and very likely go public at some point. So, but in terms of public companies in frontier markets, we own a company in Kazakhstan called Kospi, which trades in London, which is one of the most profitable companies we own, actually. And I would also point out that that's, there's a whole bunch of countries that aren't even included, because in order to be a frontier market or an emerging market, you have to actually have a stock market. So you have these countries, in Latin America, they don't have a stock market, but they have people, and someone's doing business there. But
yeah, or Africa, yeah, that's really interesting. What you say about Bangladesh? We had a guy on the podcast about a year or two ago, and he was based in Hong Kong, and we spoke all about Asia frontier markets, and Bangladesh was his favorite of all of them. He spoke a lot about Indonesia at the time, but okay, that's great. Right. So any companies then that are investable in the U.S. that have a lot of frontier market exposure where you would want it. And the reason I ask is because you talk about China and the consumer. Well, some of the biggest profits off of China have been made by European luxury goods makers, right? So that's one way. Starbucks has massive business in China. But
the first China strategy that Burton and I developed, we called it China for Chickens. So we hired a bunch of Chinese analysts and developed a way to assign a China factor. So we wanted the U.S. and international developed companies that had the most positive exposure to China, and that strategy, I think, has worked very well for investors. But you're right; you could buy Louis Vuitton, Caterpillar, Nike, Starbucks. The most obvious one was Yum Brands.
Right.
Going back to the database, what are you? We're headquartered in Louisville, Kentucky, but all of our revenue comes from China.
Yeah.
So they've actually spun that off to a separate stock now. But so you can do it that way. But again, I think that, and this is, if you look at what's been the best way to invest in the United States, the internet companies. Right. The internet companies, followed by the NASDAQ, followed by the S&P. All of them driven by the same story, right? Because a lot of that growth, if it's not the actual internet companies, it's the people making the smartphones or the parts for the smartphones. So this whole thing is basically driving everything. China, the returns haven't been great, but the tech returns have been the best. And I think that's the way to invest in these, next generation emerging markets, the next frontier beyond China. There's there'll be a lot more IPOs, in the coming years, but India right now is just so incredibly compelling. And that's really where we've been focusing most of our time.
Is there a country that you could invest in if you could, that is uninvestable? There's a whole bunch of them. Any thoughts on that?
Well, uninvestable has taken on a lot of meaning in my world, and most frequently that's used to describe the Chinese companies as being uninvestable.
No, but I mean in terms of just like the pure infrastructure, like you said.
No, I understand what you mean, but that's, as that I've heard people say to me hundreds of times, aren't Chinese companies uninvestable? And my sarcastic return is no, they're trading right now on the New York Stock Exchange. They're totally investable. If you're trying to say they're not a good investment, then that's a different thing. But people like to use these little catchphrases that they hear from other persons say. So now Russian stocks are uninvestable.
Oh, yeah.
So now, which is another interesting part of the story, because, there were 6 Russian internet companies that were public that we own. You still have the shares.
Yeah.
They're marked to 0.
Yeah.
And it was I mean, obviously there's all sorts of tragedies involved with that story, but some of these companies had just recently been public. They were very profitable. And a lot of them remain in limbo. And in fact, I have no idea how this will play out, but I just read last night that Yandex, the Google of Russia, which was halted. It was one of our stocks we owned, but we had marked it to zero because we can't sell the stock and there's no market for it. But they're preparing to sell the Russian asset to a group of Russian investors. And I think it's technically registered in the Netherlands. And so it's possible that we'll regain some value in those shares. But it's so I guess I don't know, that's not a very great answer to your question, but Russia, I wish we had more ways to invest in Africa, frankly. I mean, the Africa, demographically, as Burton, my partner, has pointed out recently, they're going to be they're going to be very, very big, and they're going to be 25 or 30% of the world's whole population at some point in the next few decades. And unfortunately, there are no publicly traded African internet companies. That's not true. We have one, Jumia.
I was going to say, yeah,
from
they just reported
Nigeria,
earnings, yeah.
But it's struggled a bit.
Yeah.
But there are, it's happening there. In fact, it's one of the interesting things is that Africa has actually got the most developed payments market on the planet but it's all on this M-Pesa platform, which is operates on flip phones, traditional feature phones.
Yeah. That's really cool. All right. Kevin Carter of EMQQ EMQQ Global. In closing, maybe tell our listeners how they can find out more about you, more about your firm, and where they can go to do all that.
Yeah, sure. Well, easiest, our website is EMQQglobal.com. And that's where you can find out all about us. And you can find me on LinkedIn, which is a great way to connect and follow what we do and ask any questions or what have you.
Cool. You're not on any of the other social medias?
LinkedIn is
okay,
preferred.
Fair. Yeah. Awesome. Well, thank you for that. Thanks for coming on, Kevin. Thank you all for listening, and we will speak to you again next time. See you then.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.